Liabilities are debts or responsibilities owed to another individual or entity. A liability, for example, can be as modest as an IOU to a friend or as large as a multibillion-dollar loan to buy a software business. Liabilities are the building blocks of a company's finances that are frequently utilized to fund operations and expansions. A liability is nothing more than a debt or obligation. The majority of people have liabilities in their daily lives, such as car payments, rent, and credit card obligations. Liabilities are similar in corporate finance, but on a much larger scale. Long-term loans for funding operations, money owed to vendors or suppliers, and warehouse leases are all examples of liabilities for a firm. A liability exists when a corporation owes someone or something money. Who handles these debts? Business owners and members of a company's financial team are accountable for recognizing what liabilities their firm has and how they influence the organization as a whole. Accountants must also grasp how these debts and responsibilities affect an organization's finances. Accounting processes sometimes entail investigating the interrelationships between liabilities, assets, and equity and how they affect a company's profitability and performance. Even in corporate finance, such as investment banking and private equity, understanding the role of liabilities in a company's financial structure is critical to comprehending the company's overall financial position. Different types of liabilities. Current liabilities are pressing debts and commitments that require immediate action, whereas non-current liabilities are important but do not require immediate action. Current liabilities are debts and commitments that are due within a year. Examples of common current obligations include accounts payable, money owed to lenders, clients, customers, and suppliers by the company. Loans for the short term, loans with 1 year or less repayment terms. Long-term debt payments. Payments are due on larger loans with repayment terms of more than 1 year, and the balance owed is classified as a non-current liability. Interest, loan interest that has not been paid. Liabilities accumulated, any outstanding short-term loans from earlier fiscal periods. Federal, state, and local income taxes that have not yet been paid. Unearned revenue or deferred revenue, money received by the corporation for goods or services that have not yet been delivered to the customer. Paper for sale. Unsecured promissory notes with fixed interest rates used by businesses to fund critical liabilities such as payroll. Non-current liabilities, also known as long-term liabilities, are debts and commitments that are due in the future but not within the next year. Non-current liabilities include the following. Bonds are a sort of marketable instrument with a set maturity date, when full payment is due, and interest rate. Tax deferral, federal, state, and municipal taxes are payable, however, they are not due at once. Debt for the long term, loans and other debts that are not due within the year, including unpaid principal on loans paid in installments. Mortgages are debt agreements in which the lender has the right to repossess the property if the debt is not repaid. Leases, payments made in exchange for the use of another person's property or assets, such as machinery, office space, and automobiles. Pensions, employee retirement funds. Liabilities that are contingent. A contingent liability is a form of debt or obligation that may or may not occur in the future. These are contingent on, or reliant on, specific events. Legal expenses incurred as a result of a lawsuit are the most common example of a contingent liability. For example, if the corporation wins the case and is not required to pay any money, it is not required to pay off the debt. If the firm loses the litigation and has to pay the other party, the company must cover the obligation. A warranty is another example of a contingent duty. If a company's product needs to be repaired or replaced, the company must have the finances to honor the warranty agreement. However, not every probable scenario can be anticipated. As a result, only specific contingent commitments must be declared when it comes to reporting a company's finances. Accountants are only required to identify probable liabilities on a company's balance sheet under generally recognized accounting principles, GAAP. These are events that are quite likely to occur, and the cost may be calculated properly. The balance sheet does not need to include the other two types of contingent liabilities, possible and remote, because they are less likely to arise and considerably more difficult to predict. However, accountants should note potential contingent liabilities in the footnotes to the company's financial statements.